All right, let's talk about one of the riskiest, most controversial games on Wall Street, short selling. It's basically a strategy built on betting against a company's success. And believe me, when these bets go wrong, they go wrong in a huge way.
And there's no better example of that than this question right here. It's a mystery that totally rocked the markets. I mean, we're talking about GameStop, a struggling video game store, somehow becoming the center of this massive financial earthquake. Not once, but twice. So how on earth did that happen? Let's get into it.
I mean, just look at these numbers. It's a wild story. In early 2020, you could pick up a share of GameStop for less than $2. But by January of 2021, it shot up to over $80 a share. This was no accident. It was actually a coordinated push from a whole community of everyday investors on Reddit. They saw these big Wall Street funds betting against the company, and they decided to fight back. And to really get how they did it, you first have to understand the weapon they used against the big guys.
So, what was this weapon? Well, it's a financial strategy called short selling. And here's the twist. It's all about making money when a company's stock price goes down, not up.
Okay, so here's the basic idea. Normally, you buy a stock low and hope to sell it high, right? Simple. Well, short selling completely flips that on its head. You start by borrowing shares of a stock. Then you immediately sell them at whatever the current price is. The hope is that the price will then fall. If you're right, you buy the shares back at that new lower price, return them to the person you borrowed them from, and voila, that price difference is your profit.
So how do you actually do this? Well, first, you need a special kind of brokerage account called a margin account. That's what lets you borrow in the first place. Then you find your target. Let's imagine there's a company called Short Me Co., and you think it's way overvalued at $50 a share. So you tell your broker, hey, I want to borrow 200 shares. You get them, and you immediately sell them on the market for $10,000. Now comes the waiting game. If you're right and the price drops, you just buy back those 200 shares for cheaper, give them back, and you pocket the difference.
And this is where you see just how high the stakes are. Let's look at the best case scenario. Short Me Co.'s stock falls to $40. Great. You buy the shares back for $8,000, and you've just made a cool $2,000 in profit. But what if you're wrong? What if the stock doesn't drop, but instead it jumps to $70? Well, you still have to buy those 200 shares back to return them. Only now it's going to cost you $14,000. You just lost $4,000 on the deal. And that is the massive danger of short selling.
And this really gets to the core risk here. Think about it. If you buy a stock for $50, what's the most you can possibly lose? $50, right? If the company goes bankrupt, the stock goes to zero, that's it. But when you short a stock, there is no limit to how high the price can go. It could go to $70, $100, $500, and your losses just keep getting bigger and bigger with every single jump. Your potential loss isn't just big, it's theoretically unlimited. Okay, so now that we've got a handle on that enormous risk, let's circle back to GameStop. Because what happened with GameStop wasn't just a case of a bet going a little bit wrong. Oh no, it was a complete, catastrophic backfire for the short sellers. And it has a name. A short squeeze. A short squeeze is pretty much a short seller's worst nightmare. It's what happens when a stock that a lot of people are betting against starts to go up instead of down. All of a sudden, those short sellers are losing a ton of money. So what do? They have to scramble to cut their losses, which means they're forced to buy the stock to close out their positions. But wait, all of that panic buying creates more demand, which pushes the price even higher. That forces more short sellers to buy, and you get this insane upward spiraling death trap.
And that is exactly to a T what happened with GameStop. It all started with some analysis from folks like Roaring Kitty on Reddit, who made the case that the company was actually undervalued. Then a big-name investor got involved, which gave people more confidence. Suddenly, you had all these everyday investors who felt like the whole system was rigged against them, and they just piled in, buying up shares and driving that price up. That's what triggered the massive squeeze back in January 2021 that just crushed the hedge funds. And what's wild is that the whole thing basically happened again in May 2024, after a single post from Roaring Kitty kicked the whole frenzy off one more time.
And the amount of money we're talking about here is just staggering. During that May 2024 comeback, short sellers lost an estimated $2 billion. That's billion with a B, in just 2 days. This wasn't just a couple of bad trades, this was a massive shift of wealth, all fueled by social media and a surprisingly deep grasp of how the market really works.
Now, the GameStop saga involved all kinds of hedge funds, but there's a very specific kind of player that lives and breathes this stuff, the activist short seller. And they bring up a really interesting question. Are these guys the good guys, acting like market watchdogs, or are they just wolves in disguise?
You see, an activist short seller doesn't just place a quiet bet against a company and hope for the best. No, their whole game is to take a short position and then publicly release a bombshell report. They'll often accuse the company of things like fraud or terrible management. Their goal is to basically convince everyone else that they're right, triggering a sell-off so they can profit when the stock price tanks.
And one of the biggest names in this space is a firm called Hindenburg Research. These guys have made a name for themselves by going after huge companies. They're the ones who published a report on the electric truck company Nikola that basically led to its founder resigning. And they famously took on the Adani Group, a massive conglomerate in India.
And these reports can be absolutely brutal. With Adani, Hindenburg essentially accused one of the richest men on the planet of pulling off a massive corporate con job. And the effect? It was immediate, and it was devastating. After the report came out, something like $100 billion in market value for the Adani Group just evaporated.
But there's a flip side to this, of course. Critics argue that this is an incredibly dangerous game. They accuse some of these activists of a tactic called short and distort. It's like the evil twin of a pump and dump scheme. The idea is they might spread false or super exaggerated negative claims just to tank a stock and make a profit. And you can see the problem, right? There's a huge conflict of interest when you stand to make a fortune from the very chaos you might be creating.
Which brings us to the big question, the final verdict. Is short selling a necessary tool for a healthy market, or is it just a destructive force? And the truth, like it usually is probably somewhere in the middle.
So the whole debate really boils down to this. The people who support it say, look, short selling is crucial. It gives people a real financial incentive to dig for fraud and helps stop stock market bubbles from getting out of control. But on the other side, the cons are pretty serious. You've got that risk of unlimited losses we talked about. It can be expensive to do. And at the end of the day, you're fighting the general trend of the market, which usually goes up over time.
And this isn't just a theoretical debate. Regulators are trying to figure this out right now. Just in late 2023, the SEC brought in some new rules to make big investors be more transparent about their short positions. The idea is to just shine a light on what's happening. But of course, critics immediately fired back, saying this could scare short sellers away and get rid of a really important tool for finding companies that are built on a house of cards.
And so that leaves us with this final, really tricky question. You can think of short selling as a kind of immune system for the market. It's supposed to find and attack companies that are unhealthy or fraudulent. But in today's world, where a single meme or Reddit post can set off a billion-dollar chain reaction, sometimes that immune system starts to look more like an autoimmune disease, attacking everything in sight. And figuring out how to control those risks without losing the benefits, that's one of the biggest challenges in finance today.